Ben, let's talk about euro area inflation. We're waiting for that data in a couple of hours' time. And I wonder what difference that's going to make to the markets, actually, because I think we're expecting it to come down from 2.6 to 2.5%. I mean, it's moving in the right direction from the ECB's perspective, but not a huge achievement. How much of a market mover can this data point be?
It's not going to be very much of a market mover. It's certainly not going to move the dial very much on front-end German yields because, as you mentioned, we are expected to get a 2.5% reading. But more importantly, if you look at core inflation, it's supposed to be coming in at 2.8%. If the forecasts are right, that will make core inflation closer to 3% than 2%. So the ECB is not going to be very convinced that, the inflation goal has been conquered. We had Philip Lane comment on Bloomberg TV just earlier on that, look, the HICP gauge doesn't do it for services inflation, and they need to see the contours of not only services inflation, core inflation, but also wage pressure, wage inflation. And they won't have the data, crucial set of wage data, before the September meeting. So we are not going to get any chance of a rate cut in July. Even in September, a lot depends on what that kind of data is going to show. So, in short, there is not much of an incentive for either German yields to move lower or for the markets to price in more cuts than they're expecting. At the moment, the markets are thinking like 40 basis points of rate cuts from the ECB in the remainder of the year. I remain skeptical. I think that one rate cut in the remainder of the year is more like it.
Ven, should I make any big trades in European government bonds until I know the outcome of the French election?
Well, I think that, the risk-reward equation has changed, Guy, in favor of French bonds. Let me explain why. If you look at the yield spread on France to Germany, it's bobbing around 80 basis points, say 75 at the moment. But look, where do we go on France in the risk spectrum from here? There are only two possible scenarios from here looking likely. One is that Le Pen gains a majority, in which case the markets won't like it. But Le Pen has already said that, look, they're not going to be spending a whole lot. They are mindful of what is going on with investor reaction. The other side of the equation is a hung parliament, which will also rein in excesses in terms of fiscal spending. So if you look at the risk-reward equation, France is a AA minus rating, and the worst it can get to is an A handle. And if you look at, which is the rating that Spain has currently. So if you look at Spain over France yield, that makes more of a sense, and there the spread is only 10 basis points in favor of Spain. In other words, markets are already thinking that France is trading like Spain. So come another 10 basis points, France would start to look increasingly like a bargain, and that's what investors should focus on.